Have you ever stopped to think about what would happen if, out of nowhere, you lost your main source of income? Your job, your salary, gone, no money coming in. But the bills keep coming. Rent, groceries, gas, credit cards, everything is the same. So what? What would you do? Now imagine the opposite. Imagine waking up, looking at your phone, and seeing that money has been deposited into your account. Again. Without having sold anything, without having worked anymore, without having to depend on a boss, a client, or luck. Just because you had the right attitude to invest in the right place. That's exactly what dividends do for you. They're money you receive just for owning a part of a company. Remember when you were a kid and helped someone in your family and got a little money as a thank you? Dividends are similar, but the one paying you is a real company. It makes a profit and shares part of that profit with you. It's that simple. So what are dividends? They're cash payments that companies make to their stockholders. Typically, they happen every 3 months. If a stock pays $1 per quarter and you own 100 shares, that's it. $100 dripping into your account without you doing anything else. And the most amazing thing, you can use this money to buy more shares, and then the cycle begins. More shares, more dividends, more income. It's like building a machine that slowly prints money, but every month, every year. And if you think this is only for the rich, hold on tight. Because in the next topic, I'll show you how this strategy is much more accessible than you imagine, and how it can change your life. Now that you understand what dividends are, here comes the question everyone asks. But is it worth living on just that? Imagine this. You build an income that goes into your account every month, rain or shine, the market rises or falls. It sounds like a dream, right? But it is precisely this stability that makes dividends one of the easiest ways to generate passive income. And look, when I say passive, I really mean passive. You don't need to start a business, become an influencer, or do a little dance on TikTok. You just need to invest wisely. Now, of course, it's not all sunshine and rainbows. Dividends are stable, yes, but that doesn't mean they're magical. The company needs to be healthy, profitable, and well managed. Only then will it continue to pay you without fail. But do you know what's most powerful about all this? Even when the market is falling, like during crises and recessions, many companies continue to pay dividends, and some even increase the amount they pay. Think about it. While your neighbor is desperate because his fund has lost 30% of its value, you are there, receiving money calmly. This gives you incredible power, the power to continue investing when everything is cheap and still getting paid for it. And that's not all. Do you know that anxiety that many people feel when the stock market goes up and down? Dividends work as an emotional sedative, because even if the stock price fluctuates, the money keeps coming in. It's almost like a salary that doesn't depend on a boss. So yes, living off dividends is possible, and more than that, it's desirable if you want to build true freedom. But to do that, you need to know how much to invest, how to choose the best companies and put together a smart plan. And that's exactly what we're going to look at now. Do you want to learn how to make money while you sleep? Then subscribe to the channel and receive exclusive tips every week to transform your investments. Let me tell you something that few people talk about. Dividends are great, but they don't come with a guarantee. And this is where a lot of people slip up badly. Imagine that you have set up your portfolio. You are excited. You start receiving your first payments and you think, now it's going to happen. My financial freedom is coming. But then the company announces, we are cutting dividends. It's over. Out of nowhere, that income you were counting on disappeared. And that's no exaggeration. It really happens. Companies face crises, make bad decisions, change their strategy, and that's it. What seemed safe is no longer so. Want a real-life example? 3M, a giant corporation, used to pay out hefty dividends. It seemed solid, but in recent years it has lost more than half its value due to lawsuits. The result? Many investors got stuck in an investment that was paying well, until it stopped paying so well. It's like renting a house, and suddenly the tenant stops paying. The income disappears, but the bills remain. And that's why you need to be careful. Dividends are not guaranteed income forever. They are a reflection of the company's health. If the company does badly, your wallet feels it right away. And there's more. Sometimes the stock continues to pay well, like 5%, 6%, but the value of the stock drops 30%, 40%. Then you look and think, money is coming in, but my equity is evaporating. There's no point in earning dividends if at the same time the company's value is losing. Therefore, the secret is not to go after the highest returns. The secret is to choose solid companies with a consistent track record that prioritize growth and responsible dividend payments. This is what separates the conscious investor from the deluded investor. And don't worry, because the good news is, yes, there are companies like that, and they're closer than you think. Want to know how to find these opportunities? Then stay with me, because in the next topic we will talk about the type of company that, even in a crisis, continues to pay you like a Swiss watch. If you dream of living off passive income, this channel is for you. Click the subscribe button and start building your financial freedom right now. Now we get to a part that many people ignore, but that can make all the difference: the taxes. Yes, my friend, the government always finds a way to get its share, even in your dividends. And do you know what the detail is? You pay tax even if you don't sell anything. That's right. Unlike when you buy a stock and only pay tax if you sell it for a profit, dividends are taxed the moment they hit your account. You didn't even blink and the lion already took a bite. And depending on how much you earn, this bite can be big: 10%, 15%, 20%. Sometimes even more if you add the company tax that you already paid before passing on this money to you. Yes, it is a disguised double taxation. The company pays tax on its profits. Then you pay tax on what it distributed to you. Sound fair? Not at all. But that's the rule of the game. Now, of course, there is a light at the end of the tunnel. If you earn very little, like less than $40,000 a year as a single person or $83,000 as a couple, and you receive so-called qualified dividends, you don't even pay any tax about them. Cool, huh? But be careful. Not all dividends are qualified, and understanding this difference could mean more money in your pocket or more tax to pay. Ultimately, dividends are a great source of income, but you need to know how to play the tax game intelligently, because there is no point in earning $1,000 in dividends and leaving $300 in the hands of the government unnecessarily. Therefore, before setting up your strategy, understand how dividends are taxed, how to minimize this bite, and how to invest efficiently. This is where the difference between those who live off dividends and those who only dream about it comes in. Do you want to know how to build a stable, diversified, and yet minimize the impact of taxes? So stay with me, because in the next topic I'm going to show you exactly that. Now let's break a myth that many people still believe: dividends are always good. Look, I know that getting money in your account every month sounds wonderful, and it really can be, but here's the cold, hard truth. A high dividend doesn't pay off when the company is falling apart. Imagine this: you buy a stock that pays you 5% per year in dividends. Sounds great, right? But then the company goes into crisis, loses lawsuits, makes losses, and its stock plummets 30%, 40%, even 50%. Don't waste time. Sign up now and get access to the strategies I use to earn almost $10,000 per month in dividends alone. Result: you made 5% but lost half your money. There is no dividend that can save it. Want a real-life example? 3M, a giant company that has been solid for decades, still pays more than 5% in dividends. But in the last 5 years, it has lost more than half of its value due to lawsuits. That's right. If you had invested there just for the dividends, you would be at a loss today. And the most dangerous thing is that these companies, in order to keep the dividend attractive, sometimes continue paying even when they are not making a profit. This may seem generous, but in practice, it is like bailing water out of a leaky boat. So, here's the message. High dividend alone means nothing. What really matters is the quality of the company behind it. Is it growing? Does it have consistent profits? Does it have good management? Think of the dividend as the cherry on the cake. But if the cake is bad, the cherry won't save it. So if you want to live off dividends safely, start by focusing in the right companies, and not just the percentage they pay. And that's where the next point comes in. How to find reliable companies that pay well and still resist even the worst crises. In the next topic, we'll get straight to the point. Now just imagine. The entire stock market collapses, everyone panics, headlines everywhere. And in the midst of this chaos, there are companies that continue to pay you. And better yet, some even increase your pay. It sounds like something out of a movie, right? But it's real. During some of the biggest crises in history, like recessions and even wars, there were companies that not only maintained, but increased dividends. Do you know what that means? Stability, predictability, confidence. An example of this happened right after World War II. While much of the economy was still recovering, there was a company increasing dividends by up to 46%. This is not luck. It is a solid business model with strong cash flow and commitment to the investor. And here's the detail that almost no one talks about. Even when dividends fall, they fall much less than the value of the shares. On average, the market can fall more than 30%, but dividends only fall by around 0.5%, almost nothing. In other words, if your plan is to live off passive income, this is gold. Because in times when the value of the stock plummets and you don't want to sell anything, dividends continue to arrive as a steady salary. Here, you won't find empty promises, just real tips to make your money work for you. Sign up and follow along. And let's be honest, that's worth its weight in gold when the rest of the world is in a panic. Now, if you're thinking, okay, I want that peace of mind, where can I find these companies? Don't worry. In the next topic, I'll show you exactly what the kind of company that delivers reliable dividends, even when everything seems to be falling apart. Now that you understand that some companies manage to maintain dividends, even in difficult times, let me introduce you to a special group. They are the real dividend stars, dividend aristocrats. You know those companies that find a way to never let you down? Well, these companies do exactly that, but in a special way. They increase the amount they pay in dividends to investors every year without missing a single year. And they have been doing this for more than 25 years in a row. Just imagine the discipline and strength this demonstrates. There are 65 gigantic companies with decades of history that have gone through economic crises, market bubbles, recessions, and even wars, but have never stopped paying, and more than that, have never stopped increasing the value they return to their shareholders. These companies are not only big, they are true examples of resilience and commitment. Why is this so important? Because for those of you who want to live off dividends, the security of receiving a growing amount, even when the market is in turmoil, is worth its weight in gold. It's like having a source of income that never runs dry, that grows over time and helps you maintain your standard of living, regardless of what happens outside. The yield of these dividend aristocrats is usually between 2% and 3% per year. This may seem low compared to those companies that pay super high dividends, but here the game is different. Consistency and security are much more valuable than a high and unstable number. When you combine several of these companies into a portfolio, a truly diversified basket, you create an income-generating machine that is stable, predictable, and resilient. Exactly what you need to ensure a reliable and long-lasting income. And there's more. Many of these aristocrats manage to do even better than the market in times of crisis, protecting their assets from the exaggerated volatility that leaves many investors desperate. Every week, I bring you content that can change your financial life. Subscribe and don't miss out. Now, the big question everyone asks, how much money do I need to invest in these companies to be able to live off the dividends alone? In the next topic, I will show you the complete calculation so you can understand how much you need to accumulate by investing in this type of company to guarantee an income of around $50,000 per year, which is an average of what many people spend to live comfortably in the United States. Get ready, because this will help you draw up your plan, set realistic goals, and show you that living off dividends is not an impossible dream, but something that anyone can achieve with the right knowledge and discipline. Stay with me, because we're going to delve deeper into this subject. Okay, now let's talk about what really matters. How much money do you need to save to live off dividends alone? And for that, we will use an example that will help you understand it clearly. Imagine a person who wants to live on about $50,000 a year, which is more or less what many retirees spend to have a comfortable life here in the United States. That's a good benchmark for us to work with. Now, remember that average yield of the dividend aristocrats that I mentioned, something between 2% and 3% per year. To make it easier, let's use 3% average yield. So if you want to earn $50,000 a year just from dividends, and those dividends represent 3% of what you invested, how much do you need to have invested? The answer is more or less $1,670,000. In other words, to guarantee this annual income of $50,000, you need a robust investment, but it is not impossible to achieve. If you start investing early, reinvest the dividends and maintain discipline, you can get there. And there is good news. If you invest, for example, $5,000 per year for 40 years, with reinvestment of dividends and growth, it is possible to reach that amount. I know $5,000 a year may seem like a lot, but if you think about it as something like $400 a month, it starts to seem more tangible. And remember, the key is time and consistency. The sooner you start and the more disciplined you are, the better. But don't worry, the story doesn't end there. If you are one of those who does not have the patience to wait decades or wants to speed up the process, there are other strategies and options that I will tell you about in the next topic. So, don't miss a beat, because this part is essential for you to put together your financial plan and set real goals that make sense for your life. Great. If you thought that investing only in dividend aristocrats was the only option for those who want to live off dividends, get ready, because there is another strategy that many people have been using to accelerate their income, the so-called ETFs, covered calls. But what is this? Imagine that, in addition to receiving dividends from the shares you own, you also earn extra money by selling options, which are contracts that give someone else the right to buy your shares at a fixed price for a set period of time. Sounds complicated? Let me simplify it. Think of it this way. It's like renting out your shares to someone else, and in the meantime, you receive a monthly rent called a premium. Even if the market goes up or down, you continue to receive this money, which can be much higher than the traditional dividend. A famous example is the ETF called Often, which has a yield of around 10.7% per year. This means that theoretically, you could receive 10.7% of the amount invested every year just with this strategy. Just imagine, to generate an income of $50,000 per year, you would need an investment of around $500,000, much less than the $1.6 million we mentioned earlier. It seems like a perfect shortcut, right? But wait, there's a catch. This strategy limits your profit when the market is booming, because whoever rents your shares has the right to buy them at a fixed price. So you may miss out on that extra profit if the shares go up a lot. Furthermore, if the market falls, the value of your shares also falls, and you may lose money on the price of your shares, even if you receive the premiums. In other words, there is no magic way to make money easily and safely at the same time. Therefore, my tip is, if you are going to use this strategy, do it in moderation, within a diversified portfolio. so as not to put all your money at risk. Ultimately, diversification is the key word for investing safely and with peace of mind. In the next topic, I will talk more about the risks and precautions you need to take to avoid losing money in this world of dividends. Stay tuned. Now that we have talked about the advantages and even these more advanced strategies, it is important to understand the risks and precautions that you need to have when investing to live off dividends. First point, dividends are not guaranteed. Unlike a fixed salary that is deposited into your account every month, dividends depend on the health of the company. If the company starts to experience financial difficulties, it may cut or even suspend dividend payments. This has happened to several large companies in the past, and it could happen again. Just imagine, you're counting on that money to pay your bills, shop, travel, and suddenly the company cuts the dividend? That could leave you in a complicated situation. Second point, the stock price can fall. Even if the company pays dividends, the stock price can plummet if the market or industry is doing badly. This means that your equity could decrease, and if you need to sell, you could end up losing money. A classic example is 3M, which paid high dividends, but has lost more than 55% of its stock value in recent years due to lawsuits and financial problems. Third point, dividends are taxed at the time you receive them. Unlike stocks, which you only pay tax on when you sell them, dividends are already in your account and you have to pay tax on them every year. This can reduce your net income and, depending on your salary, can be a considerable dent in your money. Finally, there is the issue of dividend efficiency. Some economists say that dividends do not create any extra value for the investor. In the end, it is as if the company distributed part of its profits to you in cash or increased the share price by an equivalent amount. In other words, you do not earn more, you just receive it in different ways. So what does this all mean? Living off dividends isn't just about sitting around and waiting for the money to hit your account. You need to plan, understand the risks, diversify your investments, and be prepared for the ups and downs of the market. In the next topic, I will show you my personal dividend portfolio and how I balance it all in practice. Stay with me, and good things are coming. Finally, let me quickly share how I organize my dividend portfolio and what I learned on this journey. Today, I receive almost $10,000 a month in dividends alone, and that comes from three main sources. First, an ETF that tracks the US market with an average yield of about 1.5%. This fund has thousands of large, stable companies like Apple, Microsoft, Coca-Cola, the giants that pay regular dividends. I have over $3.8 million invested in it, which generates about $5,000 a month. Second, an international ETF that includes large companies from outside the US, such as Nestle, Toyota, and Samsung, with a yield of around 2.6%. This brings diversity to the portfolio and gives me more security because not everything depends on the US market. I have almost $1 million in this part, which earns me about $2,000 per month. Third, a selection of individual stocks I've chosen to try to beat the market and increase my income a bit. Altogether, that's about $9,400 a month, which comes out to about $112,000 a year, an amount that makes me feel comfortable regardless of how the market behaves. But remember, how much you need to invest depends on your lifestyle and expenses. Those who live in New York will need more than those who live in the interior of the country, for example. The secret in the end is to start as soon as possible, be consistent in your contributions, and diversify a lot to reduce risks. And of course, dividends are a great way to earn passive income, but they are not the only way to build wealth. For those who are young and do not need immediate income, investing in growth can be even more advantageous. So use dividends as an important piece of your financial puzzle, not the only one. And if you want to start investing today, one tip is to use a reliable platform that gives you access to good investments, quality information, and ease of managing everything. This makes all the difference in your journey. That's it. I hope this content helps you better understand how much money you need to live off dividends alone, and how to get there with planning and strategy. Thanks so much for following along. If you enjoyed it, share it with your friends, and let's go together on this journey towards financial freedom.